Hey everybody, Brian Shannon here from alphatrends.net. Today is Friday, the 1st of August, 2014, and let's take a look at the numbers and then onto the charts. July closed lower for the month, and this week we saw some pretty good losses in the indexes. Oil was actually hit the hardest, but the financials were hit 3%. Russell 2000 continues to be weak, and the S&P 500 lost some ground here, obviously, as well. So let's take a look at the charts, starting with the daily chart of the S&P 500. We did break this trend line, and that trend line was something that we were watching. I think a lot of people were watching, and then we saw that I was thinking that we had the potential for support at the rising 50-day moving average. And as I say all the time, you don't want to blindly buy at a moving average, because all that is a potential level of support. So when that 50-day moving average was touched at 195.37, that occurred yesterday, you can see there was zero evidence that the buyers were stepping up at that point. We were below a declining 5-day moving average, and that means in the intermediate term, guilty till proven innocent, that you don't trust rally attempts. If we look at just the 2 days, we can get a little bit closer look at that and see in here that, again, that level did not hold as support, the 50-day moving average. We have a pattern of lower highs and lower lows below a declining 5-day moving average, and on the daily time frame, we look at this and say, yes, we're still in a primary uptrend in this market. So we say, well, what are the potential levels of support? We've got this trend line here that kind of coincides with the 150-day moving average. Then we have that 100-day moving average at about 191.30, and this prior level of resistance near about 190. So the truth is, nobody knows how far this thing will pull back, but what you have to do is use this as a lesson or as a drill, let's say. We've been hearing for years that this market's going to end badly. That it's going to end badly and that sort of thing. The fact is, it only ends badly if you're not prepared. If you don't manage risk, then it will end badly. Know what your risk parameters are. So for me, as you know by now, anytime the market gets below a declining 5-day moving average, I turn to intermediate term guilty till proven innocent, meaning I'm not expecting the average stock rally to hold. You always have to take each stock on a stock by stock basis, of course, but with the S&P 500 down as much as it is here the last couple days, you would think it needs a bounce, but I wouldn't say that you would want to be a buyer of that bounce for anything other than day trades. We did close right at the volume weighted average price today, and for the week, the volume weighted average price is about 195. Now, going into next week, I think that what we've got to look at is we've got the potential for resistance up near that 195 to 195 and a half. This prior band of support is likely to become resistance. Now, it doesn't mean you sell short if it gets up there. Instead, you see if it gets up there, you then look at it on a shorter term time frame to see if there is in fact a reason to enter on the short side. So if you are a long only player, you ought to be sitting on the sidelines. If you are a more active trader, then you want to be generally scalping, I think, in here. There are always good setups to the long and short side, and we saw some great movers this week based around earnings especially. But let's take a look at the Nasdaq now. The Nasdaq, as we saw here, lost 2.1%, so not as bad on a relative basis. And we got, we came down through an important trend line here as well. And we're taking a look at a 30-minute time frame, or let's go to the 65-minute time frame. Here's that important trend line that we broke through basically today. So that didn't hold in the 90. So what we were looking at first was earlier this week, I was telling subscribers to Alpha Trends that 96 and a quarter, that's our key band for the near term. If we break below that, then we turn cautious on this market. And now with it below a declining 5-day moving average, the intermediate term trend is guilty till proven innocent. So we want to say, if we get a bounce, where does it have the potential to rally up to before it may find resistance? And it may be all the way up towards that 96 level, which obviously would be a good bounce. But we have to take it one piece at a time. Right now, the important piece is telling us that we have a pattern of lower highs and lower lows below a declining 5-day moving moving average, and that's the time to minimize the risk that you're taking. There's always risk in the market. So risk management, as I say, is always job number one. It's the most important thing. Now, a lot of people have been talking about the divergence in the Russell 2000. The Russell 2000 has kind of marched to its own drummer all year here, as it's kind of been going back and forth, above and below, break even for the year. Now it's down 4% for the year after 2.5% loss this week, and it's just really becoming a giant mess. So here's the year-to-date line. We've spent half the time above, half the time below, basically, and you could look at this on this daily chart and say, is that a head and shoulders pattern? And people will say, okay, that's a head and shoulders pattern, and what completes the pattern is a breaking of the neckline. To me, it would be foolish if, let's say, next week we break below this 107.5 level. It would be absolutely idiotic to sell short there, because you have to ask yourself right now, where has the market come from? It's come from 120. Where does it have the potential to go to before it's likely to encounter a source of demand which will provide support for it? And that would be right down at this level. So you wouldn't want to sell short below there, because it's already expended a lot of energy coming down. The fact is, it's below a declining 5-day moving average. It's guilty till proven innocent. How far down it goes is anyone's guess, but it seems like the bigger band of support should be found basically between 106.5 and 109. It's not a prediction that it will get there. I simply don't make predictions. I look to participate in the trend and manage risk. So right now, the bias should be to the short side in the Russell 2000. Semiconductors got hit this week as well. They didn't. They were up 0.35%. Last week they got hit, and we continue to kind of hover near this 50-day moving average, which is rising. Now, what we saw in the semiconductors, of course, was that we had that 49.5 to 50 level that was the band of support for this market, 49.75 really. And as it broke down, I was talking to subscribers, because this was the 50-day moving average and daily S2 on that day, saying that this seems like a place where it would get a bounce, but don't trust it because it has a declining 5-day moving average. That rally, of course, failed, and here we are back down this 48.50 level with a declining 5-day moving average. So we have to be on caution that if this level breaks, basically 48.5, that if we break below that, then we run the chance of a bigger sell-off in the semiconductors, and perhaps that would be the 100-day moving average for these guys, which is all the way down at 47. So you have to be very cautious about these semiconductors. Longer term, on the weekly time frame, yes, we're still in an uptrend, but you never know till well after the fact if that was in fact the high. So financials lost an important level of support this week too. That was 22.75. The 22.75 was our line in the sand that we've been talking about at Alpha Trends, and thinking that if it breaks that, we have to get a lot more cautious. I thought that it would probably find support down at this level, but again, that's only a potential level of support. As it's declining, you look at it and say, that's where it has the potential to find support. So let's take a look at that 22.5 on an intraday basis, and was there any evidence at all that there were buyers there? And the answer is absolutely not. It just continued lower from there. So these potential levels of support are not a reason to act. They're a reason to drill down to a shorter term time frame and say, is there evidence that the buyers are regaining control? And if they had right in here, it would have only been a day trade, I think, but because now you have to look at this market as guilty till proven innocent as well. And I think that any rally from this point, you're likely to encounter resistance between 22.45 and 22.60 now. So this prior band of support in here, which is broken, now has the potential to offer resistance for a rally attempt in here. We're right on the 150-day moving average. We can take a look at this longer term trend line and see that we're very close to hitting that as well. And perhaps we'll see a slowdown of sellers and some buyers step in, and we get a bounce from that level. Again, we're not in the job of making predictions. The job is to look at reasonable levels where it seems likely that buyers or sellers will congregate, watch the action on a shorter term time frame, and assess whether or not we can find a low risk, high probability trade in the direction of the primary trend. And right now, we're getting mixed messages on these bigger time frames, so you have to be aware that there's more risk in the market, and that you have to compensate for that by holding on to more cash, adding some short exposure, smaller share size, whatever it is that you need to do. By the way, I accidentally didn't change the price for that silver subscription. The silver subscription, or bronze rather, the bronze subscription gives you these daily videos every single day where we go over these market indexes. So I'm going to have my web guy fix that next week. So if you're interested in this type of analysis every day of the week, that is Monday through Friday, then go to alphatrends.net to sign up. Let's take a look at some individual stocks. Apple seemed like it had an appointment with $100 a share. We were long in Alpha Trends, and we had raised our stop. We had taken half of it off, I think, right over in here on this day. And then we got stopped out of the balance at $98.20 on Wednesday. And, some people were saying, well, listen, I still like it. And I think it probably will go to 100 at some point. But the market is making this little pattern of lower highs and lower lows. Our stop was hit when it made this lower low right here. So let's step aside. So right now it looks like Apple needs some time to consolidate. It's had a big run. It's right on this trend line as well. Maybe it settles down in here, but right now in the near term, I don't see any advantage to going long in here. Some of the names, other names that we traded successfully were Biogen. We got in here, took half of it off that day with a 3-point gain real quickly, and we got stopped out on this gap down. We also didn't get involved in Crox. Crox has a great looking weekly chart. They recently reported earnings over here, and we were watching for this stock to get above this level here, 1650. We were watching it on this day. We had it on our radar. What we were looking for was it to kind of run up to 1650 and then break that level, and then to put our stop, we were going to have it under here. We might have raised it to that level. So we were anticipating the trade that it would be able to turn higher, but we didn't participate because the price did not confirm what we were thinking. So here's an example of when not to take a trade, that you don't want to just buy pullbacks to a 10-day moving average or whatever, because that's not the way that stocks work. You want to wait for the trends to be aligned, where we get a higher high on the shorter term time frame. We also didn't get involved in Ballard. Ballard was one that I did a post on. I said, here this stock is getting back above, battling with the volume weighted average price year to date, and it had a band of resistance between 440 and 452. I said, clearing that level, that it seems like it should be able to get going probably up towards at least $5.50 a share. Well, the stock got close to, but not through the 452 level. So there was no reason to take that trade. There's no reason to be sitting in this with losses right now. So my thought was that it looked great on multiple time frames, and it had a big short position, and that could provide further upside. Instead, we're not in it, and it's better to be on the sidelines wishing you were in than to be in the position and wishing you were out. So in this case, there's no reason to wish you were in it. F5 was a great trade for us as well, from here to somewhere in here, and then got stopped out of the balance right there. I had mentioned this Mobileye, which came public today. They priced it at 25. It opened at 36, ran up to 39, and I said, basically what this company does, there's an alternative play, I think, which is OmniVision, OVTI. So what I was saying on a post that I posted to Yahoo, the Tumblr, was that if we could buy it between $22.50 and $23 a share, that we could buy an initial position there with a stop, worst case stop down here at 21.96. So a half a position should have been bought here, and then I said what it really needs to get the momentum is to clear last week's high of 23.09. So if you have a full position in this right now, assuming maybe you bought half of it at 22.70, and then let's say just call it 23.10, your average price is 22.90. At this point, I would say your stop would go to break even, and it's got a great looking weekly chart. I think that here we saw a breakout of a weekly pattern where this resistance became support. We've got a rising 10, 20, 30, 40 week moving average, and it seems as though the stock should be able, I think, to run up to and through these highs from the earlier in the year. The important part isn't how high do I think it can go. Price targets really don't mean a whole lot to me. We just use them to say it's part of determining whether you want to get into the trade or not. It's the reward part of the risk reward that we come up with, and a risk reward is obviously theoretical. You can read about this on Alpha Trends under the frequently asked questions, by the way. But the point is, risk management is our job. If the stock comes down through 22.90 and you get out break even, that's what the market told you to. That's what you should do. If it makes a higher low, let's say at 23.10 and then ramps to 23.75, I would raise my stop underneath that higher low. Whatever time frame it is that you personally are trading, that's where you have to make those decisions for risk management, not based on any random 5% or whatever. You want to base your stops on where you relative to where you own it into actual technical levels. So this should become support in here, and I think 22.90 would be a safe place for that stock. Today we traded Tesla, and we talked about it. The stock had gapped up and then pulled back, and today what I was saying to subscribers is back up through that VWAP, up through 231. It looks like it's a good trade. So we took some there. I'd mentioned taking half of it off up here as it hit daily R2, as those often become an area of resistance. So a 2-hour trade there took us for about a 4-point gain, and then raised the stop right here to 235.80, which was a good stop because it pulled back. So that turned into a nice day trade. Longer term, I think Tesla looks like it's likely to head back up towards this level, and you'll see people calling this the cup and handle. And longer term weekly, we're still in a giant uptrend. So Tesla's going to continue to be a great trading stock. Now to look at some damage that was done in this market. We saw some big names like American Express get hit pretty darn hard here this past week, from over the last week and a half, 96 down to 86. There's risk in all stocks. Stocks like Boeing have been hit from 130 to 120 this past week. Eaton Corp, huge loser here, just $80 a share, down to 67. And you don't buy these on the way down, not while they're below a declining 5-day moving average. General Motors, same thing. It's below a declining 5-day moving average, and since it gapped down, it's gone from 37 down to 33. I'm sure there's people trying to buy it all the way down, and none of them are getting it right in these stocks, like Goodyear, Herbalife. I mean, talk about just a ruined stock. These hedge fund clowns that are battling over it have just made this really kind of a foolish stock to be involved in. How can you trade a stock like this and trust that it's not going to gap in one direction or the other? McDonald's is another big cap name that people look at this as the blue chip. It's safe. It's something that can should be bought on dips. I say you don't buy on dips. You wait for the higher high. So for instance, with McDonald's, what we want to do is we want to see the 5-day moving average flatten out, and then we want to see a higher high above that. So if it had broken like this, it would have been good for a trade only, but with a declining 10, 20, and 50-day moving average, McDonald's is in its own bear market right now. There's no reason to be long that, and it's not whether the market is in a bullish, whether you want to call it a bull market or a bear market. I think of it as a bullish, generally bullish market, but we're seeing a corrective phase. How low it goes, whether it's the ultimate top, nobody knows that. But you look at other stocks that are big names, household names like Monsanto, getting hit from these highs right over here, which may have been, they weren't all-time highs, but multi-year highs, and just in the course of 2 weeks from 128 down to 113, and it never made a higher high above a flat to advancing 5-day moving average. So that tells you just stay the heck away from it. NRG, same thing, never made a higher high with a flat to advancing 5-day moving average, and this energy name has gotten crushed as well. Qualcomm's another one. Qualcomm had just broken out prior to earnings and really trapped a lot of people there, I think, on that breakout. And from that failed move came this fast move lower where it gapped down. I'm sure people thought it was a good buy, but it was below a declining 5-day moving average. It's still below a declining 5-day moving average. It's guilty till proven innocent. If you need to own Qualcomm or McDonald's or one of these other stocks, let the stock settle down before you decide to purchase it. To fight this type of momentum is just foolish. I hope you had a good week and enjoy your weekend. I'll talk to you next week. Thanks.